welcome back to Dukascopy TV. Today I'm joined in the studio by Angel Sanz from Notz Stucki to discuss the alternatives available to fixed income assets. Hello Angel, thank you very much for coming in today.
Thank you for inviting us here.
Now, first of all, could you tell us your perception of the fixed income market at present, please?
Okay, the fixed income market now is in an exceptional situation where the yields offered by many fixed income instruments are at the lowest level ever that we can remember. In the UK or the US, where we have a very long history of bonds in fixed income instruments, will be at the lowest level for the last 230 years. And also in this graph, we can see that as inflation rates in many countries are about 2%, we can see that many instruments like cash, short-term treasuries, domestic government bonds, investment-grade bonds, all those instruments are now yielding lower than inflation rate. So for sure, many investors are going to have negative real returns. Just to give you a much better idea, when we look at the global broad index for Merrill Lynch Bank of America, the global bond market is yielding now 1.7 percentage points with the duration of 6 years. So if we look at the second chart, it's very interesting to see the size of the fixed income market. So with this graph that has been produced by McKinsey, we can see that the equities in the world are about $50 trillion and the fixed income instruments that are tradable are about $100 trillion. So the $100 trillion investment in fixed income will deliver only 1.7% yield to maturity, which is the risk or the issue that we have most of managers now on the table.
But when do you think it might start weakening, Angel?
Okay, now we think that the economies are not strong enough to have interest rate going higher. But somehow with the good communications that we are having now with the Fed and central banks, we can somehow figure out when the whole thing might start to unwind. So Bernanke said recently that he will maintain interest rate very low or at zero basically until the unemployment rate goes to 6.5%. So if we take just this simple graph with the unemployment rate in the US and we extrapolate with a very simple regression, we may come up with October 14 when the unemployment rate in the US may reach the 6.5% point. So more or less by the end of 2014, if things continue this way, we might start thinking about Fed just hiking interest rates, but the market may anticipate that. So somehow we must be prepared in advance for this situation.
We also have NFPs this week, so that will be something interesting to look at. But what are the alternatives to fix these problems then that you're mentioning? Okay,
some of the alternatives will be be patient and stay with short-term duration bonds, 1 to 3 years. They may yield only 1 or 2%, but at least you make that. Also, just pile up on floating bonds. Floating bonds will just pay LIBOR plus 50 basis points, but we are sure that we will make that. Also, we may go to high yield, but in the graph here, for instance, we see the black line, which is the high yield towards that is delivering only 5.8%, which is the lowest level ever, also for high yield. We wouldn't buy that, but the spread of high yield is still juicy with 5% spread towards. So what we would recommend is just to go to the high yield short duration bonds that will deliver at least 5% return with very little risk, very little duration risk. Also, in emerging market and subordinated bonds, there are opportunities, but always something that is in duration 1 to 3 years or less than 3 years, I would say, to make sure we can recover the capital without just losing much capital. And one third alternative that is quite interesting in this environment is just focus on hedge funds relative value. So hedge funds are particularly good to extract value in the long-short environment for credit, equity, or fixed income with relatively low volatility and low correlation to equities. So some part of the fixed income portfolio can be switched to these hedge funds that may be less liquid but might deliver 4 or 5%, which is not much, but is much better than 1% that may deliver by fixed income. So those three might be the best alternatives that we are already implementing in our portfolios at Notz Stucki.
Excellent. Thank you very much, Angel, for your insights there. It sounds like the lesser of two evils, some of the options, but you know, things are definitely good to have alternatives on the cards. Thank you very much for your insights.
Thank you.
Thank you. Well, that's all from Angel and myself. Earlier on, I spoke to Catherine Hill regarding women in finance, so please do click back for that. Bye for now.